Hello and welcome to step number 1 of On-Demand Retirement Program. This step is about choosing your real estate market. Choosing the place, region, city where you're going to be buying your first residential real estate business. Okay, this step is quite important because it will create a good foundation for your business. If you analyze the market, if you then make right decision, your business will be expanding fast and be profitable day one. If you make wrong decision or just randomly select the area, it may result in your business struggling at very initial phase. To avoid that, I would ask you to pay attention to what we're going to be discussing here and use all suggestions and materials that I provide you with for your research. This step will have two parts to it. I decided to split it into two, simply focusing initially on the macro analysis and then going into discussing particular building and tenant type and other smaller things that in combination would give you right set of information for informed decision making. So let's get started here. As with any step, we always start with the objective. First, I want you to understand what's ahead, what you need to learn, what you need to achieve at the end. And this step, we will be learning about why we need to do market evaluation. Why do we care? Then you need to understand what criteria are used in order for you to make that or another decision about the market. So what to look for during your investigation, during your research. Using these criteria, you have to follow a certain order because some of them are more important, some of them are less. And also you need to understand where do you get all this information from. So this is a learning curve in this step. And then you'll have to explore several markets. So that would be your to-do or homework. At that point, you will first simply take random cities or random locations and will try to understand where they are at in all this real estate market situation. And then you'll have to choose what you will be, choose areas that you will be looking at as a potential place where you will be buying your properties. The ultimate goal of this step is to be able to understand the current real estate market situation around the area of your particular interest in order to make an informed decision regarding the purchase. This is just a short summary of what I've just said before. Keywords here are first to understand, and for that you need to make a research to pick up the data and know how to look at the data in order to make your decision. You will be looking at the market of your choice for sure, and all that will help you make an informed decision. Now, why do we evaluate the market? Why do we need to do that? First of all, condition of any market and region, and we're talking about real estate market here in particular. Condition of real estate market is not permanent. It's fluctuating. It's like ocean waves. It goes up and down. Why do we care? Well, because if you purchase the property at right time, it will be better for your business moving forward. If you buy it at wrong time, it will be the opposite. And we'll discuss in the next few minutes of what is good or bad timing to buy. Then, buy, rent, hold business is based on revenue from the rent. So what does it have to do with the market? Okay. From your own experience, you may know that, for example, if the area is in depression, there are a lot of properties are offered for sale and to rent, and because of that, the rent goes down. That's one point of view. Another point of view, it has to sustain your business because this is the most valuable source of income in your property. So you need to understand these two in combination, and certainly they are both affected by the market. That's why you need to understand the market condition in order to understand the rent situation. Buy, rent, hold is specific real estate strategy. And in some regions, for example, you may have a property that is quite dated. You may purchase that property, restore it or upgrade it, and then sell for a profit. And it could be good business strategy. But in the same area, you may not have properties that would be good for buy, rent, and hold. That's why we analyze the market first in order to understand if particular buy, rent, hold strategy is applicable and would fit well into the market situation at where it is right now. Coming to the market again, market current status, buy or sell. It is a bit simplified, but it is in line with what we were discussing, saying that the market is not permanent. At any market, there are times when people are normally buying properties and time when people are normally selling. So why is that? Well, market dictates the situation. This is why you need to understand where market at right now in particular area before you make any decision to buy and or sell. And we'll discuss it in details. And then coming to choosing your market segment. By market segment, what I mean by that, if you live in big city, you know for sure that in your city, in your place, there are some areas that are in most demand and others are opposite. Some are maybe even dangerous to live in. So you have to understand what market segment geographically you need to pick up, and also what we are talking about here. It is demographic situation in the area, in the segment. Like you have big university campus. What does that mean for rental real estate around that area? Or you have huge IT campus. So all these influence your decision making. So choosing your market segment is also important. And this is why you need to analyze the market first and then decide if you're going to purchase rental or multi-unit rental property there. And all of the above will play significant role in what you want to achieve, which is profitability from the day one of your business. This is why a market evaluation is essential, significant, and important, and certainly you have to pay attention to it. If you've been to our webinar, you may remember this graph. This graph represents real estate market life cycle. It may have different names for phases of this life cycle, but usually they are called expansion, hypersupply, recession, and recovery. And we then discussed that this market goes from expansion coming to the euphoria where it is the good time to sell the property, and then goes through hypersupply and recession and recovery. And the beginning of recovery is the best time to buy real estate properties, and especially when we're talking about multi-unit rentals. Okay, what I want to do, I want to look at the same life cycle using slightly different diagram now. First of all, it's a circle, so it is better representation. That's one aspect of understanding. Now, let's discuss elements or symptoms or metrics that you should look for in order to understand where certain area that you have selected is in this life cycle at the particular moment. Let's start with recession. What metrics or what symptoms are around when there is a recession? First of all, the simplest and easiest one to spot, it is when there is no construction activity. It looks like dead area. You may even have buildings with barricaded windows in there. Certainly it is higher than normally vacancy because there are a lot of properties offered and not that many people who want to rent. Prices of real estate are low at this point because of the same reason. So these are all symptoms of depression in general, and that in particular affects real estate. At the end of recession, what starts happening is that, first of all, people start looking into this market and put some money in, which leads to a beginning of activities. So some buildings are starting being renovated, for example. Prices are starting to grow in the area, real estate prices. That allows landlords to increase in the rent, which leads to lower vacancy to compare to what it was previously. All these symptoms are for recovery sector of this life cycle. At the end of that, we come to expansion, when it becomes really obvious that, well, this sector, this area is now a good area to invest in. And this is when money is starting to go in. So we see increasing construction, we see highest or near highest level of rents. And this is why people put money into it, because they see an opportunity. Rent is high and properties are in demand. That's why they are starting investing, okay? And certainly at the end of expansion, it's the biggest demand from buyers to purchase properties. It becomes that euphoria point when people just look at the market saying, whoa, what's happening? We need to buy here as well. Now, after that, as a consequences of that euphoria, what happens? Many people put a lot of money into the area and construction is booming. But with time, when properties are ready, the market gets oversaturated with properties. So it's excessive inventory. What does that lead to is that, first of all, landlords are now, we're talking about rental market, okay? Landlords are starting to compete for their tenants. How do they do that? Well, the cheapest or easiest way to do it is to decrease rent. So when you see rent declined, when you see excessive inventory, when you see lots of signs for rent or for sale and lots of construction still in place, these are symptoms of hyper supply sector or phase of real estate market life cycle. It all makes sense. There is nothing here that is super complicated or scientific. It's just logic, and this is the way the market is. Okay? Your role is to understand where in this life cycle the market of your choice is. As easy or as complicated as that. Nothing special. And obviously, since we are buying, you will be looking at the markets that are at the end of recession and beginning of recovery. So from the end of recession, and this yellowish sector is to highlight that end of recession to almost the end of recovery is the proper time when you need to buy. Now, time to sell. This is just for you as a side note at this point. We are not talking about how to sell, but logically, when expansion is at the last stage, this is the best time to sell, because you will get the most for your property. Investors will be paying big bucks for whatever you may have. Why I'm mentioning it now? Because at some point you will have to sell your property. So when you do that, when you make that decision, you may come to this diagram and to again evaluate whether it is good time to sell. Or you need to prepare your property for being sold at a certain point. And this is where this consideration is really helpful. I want to give you a couple of practical examples of how to use this real estate market analysis. What you're looking at is a snapshot. And the information is taken from the known source. And it is Commercial Real Estate Dr. Glenn Miller Real Estate Life Cycle Report. If you Google that, you will find it easily. What these guys do, they take the known for you now, the curve of real estate life cycle, and they map cities across the country, putting them at where they are, considering the life cycle, where they are at a particular moment. This snapshot was made in 2012, at the end of 2012, and that's the way it looks. It is nice to look at a snapshot taken at a certain moment, but it is more interesting and important to compare. So what I did here, I took 5 years apart, two reports that are 5 years apart, one made in 2012 and another one in 2017. So let's have a look and see what's happening, and it will give you some valuable insights. I picked Detroit, so I'm not saying you need to buy in Detroit or to sell in Detroit. I just picked a city for the sake of this exercise. So in 2012, Detroit was at the end of recovery phase of the cycle. Okay. In 2017, Detroit was at the end of hypersupply phase of the cycle. What does this mean? Few things here. First of all, if in 2012 it was wise to purchase in Detroit, it is certainly not that so at the end of 2017. Quite obvious, right? We just discussed that it is not the time to purchase when the market goes into hypersupply and recession. Then the distance is 5 years between these two events, right? Here it was end of recovery, then it was expansion, and it was end of hypersupply. So it is 2.5 phases out of 4 during 5 years. So for this particular city in this present time, it takes about 7 to 8 years to complete this cycle. That's another information. Why this may be important? Because this may provide you with details for exit when you want to sell your property. You need to be sure that you are selling at the right moment. So you need to understand how long normally the life cycle for the area of your interest would be. Now, if we take another city, let's take San Jose here. Again, in 2012, it was at the beginning middle of expansion phase. Okay, in 2017 it came to the end of hypersupply. So it is 1.5 phases out of 4 during the same time frame. That tells you that for certain areas, San Jose in particular, the life cycle is longer than for another. This is not a constraint, this is not a limiting condition, it is just the information for you. In particular, you cannot apply the lifespan of real estate cycle taken from one location onto another. All right, so if you are looking at San Jose, you cannot say, well, if it is here in 2012 and in Detroit the life cycle is 8 years, so in 2020 it will be here again. That would be wrong assumption to make. What's important here, that this is the region that I would be paying attention to if I were in 2012 and if I was going to purchase multi-unit residential property. It is the beginning of recovery. I might have been looking here as well at the end of recession, but there is nothing here. So I would be focusing on this portion and will start at least my search from the cities that are here on the list. So that is a good source of information for you if you use that resource, which is recommended. Now, it is really good idea to map your areas of interest that you will be going through, putting them on the graph like this. So what do we see here? First of all, it's a curve. It is the same real estate curve and same phases of the life cycle. We are not looking at this portion, expansion or hypersupply hypersupply are not times to buy or to sell. So forget about that. We've just discussed that the best area for you to focus on is the end of recession and the beginning of recovery. So I would say from the end of recession to the almost end of recovery is safe, and it is the time, the phase inside of the cycle where you should be focusing on. Now, here are some metrics, and I put them here just for you because they are simple and obvious, and they are important ones. We're talking about prices on real estate in general. We're talking about vacancy rate. We're talking about construction activities. So, in recession, prices are going down. In recovery, they're starting to go up. What you need to do, you need to monitor these prices in the area and see they're going down, down, down. And as soon as you see an indication the prices for real estate are stabilized or are starting to go up, that's the indication that you are right there. That's the time to purchase. Okay. Now, vacancy, same thing. You may have vacancy going up in recession, even though it is normally not that significant for multi-unit residential properties, but it is still general trend during this phase. So as soon as the vacancy is starting to going down, that's the indication that you are here. That's the indication that you are at the time when you need to purchase. Now, construction, another symptom during recession. You may see even barricaded window in some houses or some properties, and no construction happening at all. All these cranes are simply staying there. No trucks on the roads. So as soon as you start seeing activities around that, that means that you are now at the beginning or even middle of recovery. So you should be really careful choosing these criteria. You may be late when you start seeing construction, but it is also an indicator. So a good idea is when you analyze the area using all the criteria that we've just discussed and will be discussing, you will then be mapping your areas on this form. It is really simple, almost trivial form, but the idea is when you go through areas, you will then be able to understand which one is behind, which one is ahead. And we'll have something like that on your picture. You could do it on paper, you could do it on computer, it doesn't really matter. What is important that when you have that, when you look at that, and if I had this allocation of these areas on this graph, my thinking process would be, okay, well, I've done my research. So area number 3 and 4 are the best to focus on at this moment to purchase properties in. Number 2 and 5 are good. Number 1 is still behind. So it is not a good time to purchase there yet. But if I'm looking for properties here and here and cannot find anything, or I can find something but I cannot get the terms that I want, I will then be looking at area number 1 because it will be coming here eventually. Maybe while I'm searching and planning here, this area would come there and will be a great area to purchase because it is all dynamic process. All these things will be moving that direction inevitably. That's the logic. Okay, I hope this is clear and it helps. Now, just to emphasize and to reinforce this understanding, I put these 3 examples. Number 1, purchase during the beginning of the recession phase. We just looked at the recession with all the symptoms or indicators of the recession phase. So what will happen? Prices are not at their lowest point yet. So when you purchase at the beginning of a recession, you are leaving money on the table. If you wait a little bit, you would have spent less for the same or better value. Then the vacancy rate may still go up because during the recession, it is general trend, as we just discussed, for vacancy being increased. So if you're purchasing at the beginning, you base your numbers assessing the properties on the data that was received prior to recession. And during the recession, numbers, the vacancy go up, so your rent revenue will go down. So you will be less profitable than you could have been. Then inability to increase the rent, that is another important thing. You want and you will have to increase the rent soon after you purchase the property. Buying at the beginning of recession will not allow you to do that because the rent prices go down during that phase. Historically, if you put the rent up, you will lose tenants. That's all it will be. All right. That's why purchasing the beginning of recession phase is not a good thing to do. Now, another example, if you purchase during the end of expansion phase, that is even more dangerous because the market is so hot, you have higher competition. So people will be chasing properties. You don't want to participate in that chase, trust me, because you will likely pay maximum possible price for the property, whatever you are purchasing, and not getting profit in the buy. By not getting profit in the buy, what I mean by that, and it's known term actually in the industry, profit in the buy meaning that you don't involve any guesswork in your decision making. From the day one, you know that you will be profitable. You achieve that by spending certain amount of money at certain market condition at certain moment of the real estate market life cycle. Okay, it may sound complicated, but you will understand it. Don't worry about it right now. The whole point is that when it is an end of expansion phase, the prices are at their highest level. And this is what you will be paying if you buy there, which is not really good thing to have. Then another important risk here, you will be basing your evaluation on best market condition that will change shortly. Imagine that you found a property. Initial information says it's all good. Financial indicators say that, well, it is a good buy. You send an offer, the offer is accepted, the seller will send you all the numbers, you will then evaluate all financial details based on these numbers, the actual numbers. And the numbers will be showing you that, well, it's a great property, it has no vacancies, the rent is high, the profits, the margins are great. So all says that you have to buy this building. And if you didn't know where it is, where it was in the real estate life cycle, you would be making a decision to buy it. But if you know that, well, let's see what happens next. You are at the end of expansion phase. You buy the property. All numbers are great. So you put your money in. And then the hyper supply comes in, and then the depression. What this means? Well, as soon as you purchase the property, your numbers will go down because you will have higher vacancy. The rent will be decreasing. Number of people who would be able to rent your property at the level of rent that it was when you were evaluating will be not that significant. So you will have to decrease the rent. This means your profitability will go down and it will affect your business the bad way. All right. So this is why you need not only to look at all conditions of your purchase or all your terms, all the variations, including financial details, but you also need to understand where it came from. Again, all these numbers that you will be provided with by the seller come from this or previous phase of real estate life cycle. You need to understand it and take it into account. This is quite significant. This is why the step one is about understanding where the market is, and then you make your decision to purchase. Okay. You may now be thinking, whoa, that's a lot of things to be taken into account, and it is quite difficult and even scary. I want to say, don't be overwhelmed, don't be scared at all, because you are not gonna be becoming an expert in market evaluation. This is not the purpose, this is not the objective. You need to be familiar with that. You certainly need to understand that market is not a stable thing. and the market conditions are not permanent. You need to understand where the market is in real estate life cycle at a particular moment, specifically the moment when you are going to be buying your property. That's all you need to know and understand, no more than that. So don't be scared or overwhelmed. Online search will bring you most of the data. The file that you have to download has a number of links and suggestions that you will be using for your market validation. And it will be more than enough. It is less than one page, by the way. It will be more than enough for you to get all the data and all the knowledge that you need to make right decision. You will also be able, and you will have to call local municipalities or city halls and ask for information related to a particular place. That's another source of data, and people there are normally quite helpful. This will give you more confidence when you start doing this as well. Another thing is you'll have to keep in mind when you sell or when you are planning to sell. So what is your horizon, exit horizon, whether it is 5 years or 10 years. And this is pretty much all you need to know about real estate life cycle. So again, don't be scared and overwhelmed. With the information that I'm giving you and with the practice that you will go through, you will become an expert in this field, trust me on that, to compare it to most real estate agents or brokers or mortgage brokers. Okay, so it is not complicated and you don't need to be an expert, but you need to have an understanding. Now, I put this information here for you just to have a couple of comments. This is what you will have in your download. The file will have all these links and a bit more. The idea is that, first of all, there are kind of three sources here for macro analysis. It is nationwide or countrywide level. BA government side has a lot of statistics and demographic data like personal income or unemployment or family size and others. When you're going to be looking at particular areas, start there and you will get a lot of insights. Now, ULI.org, when you go there, look for real estate economic forecast. These guys put a lot of efforts to make forecasts. That will help you. While forecast is still a prediction, these people have a lot of knowledge and resources and time and money to do it right. So they provide you with quite reliable source of information. Another one, pwc.com. Same or similar thing, different perspectives. So look at both and compare. Search for trends in real estate within this portal, and they will give you a downloadable report to go through. Now, we are in multifamily real estate business. So these two links, I put them specifically, and these two will be enough for you in order to learn and implement the approach that I'm teaching you related to real estate market evaluation. Let's go to JLL.com website for a minute live, so I will be able to show you what you could find there. So this is the live link here. So first of all, you go, these guys serve many industries, okay? One of them is real estate. So you come, you search real estate, then you choose the property type, you select multifamily, and then you look at what's available. At the time when I'm putting this together, they have featured videos saying that US multifamily, that's your topic, right? Multifamily is a hit with foreign investors. So you have competition coming from Canada, in Germany, if we're talking about US market, which is a great thing. Competition means it is a market, meaning it is a profit, and that's what you're after here in particular. Now, what's hot? General United States Housing Insight, great resource. It's not necessarily about multifamily, but the entire market inside, it is normally, it correlates normally with multifamily in particular. Now, if you're looking at a particular area, here's a Los Angeles overview for multifamily. If you are there, or if you're planning to invest there, wouldn't it be a great resource to explore? Now, multifamily investment outlook, the whole report is in your disposable. Great resource again. And so on and so forth. These people put many efforts into making it quite convenient. Like, okay, the investor, multifamily sector, they give you suggestions on when and how. It is quite good reading for you as well, not necessarily something in particular to focus on, but it will put you into the mood of real estate investor. It will definitely help. And so on. I'm not saying that you should simply blindly follow what is suggested here, but I must say it is quite valuable and trusted source of information. So go there, start there, and you will have good idea about where to start your focus, or where to find deals, or which parts of the country are in certain phases of the life cycle that we've been discussing. You will also have to look up and call local authorities, like local chambers of commerce or city hall, local city web portals. Why is that important? Because doing macro analysis is great. It will give you an idea about the area in particular, fairly large area. But then when you focus on a particular place, you may not find easily related information on the sources that I mentioned above. But if you call local places, they will be more than happy to help you, because people in City Hall, for example, they are looking for investors who wants to put money into the area. So they're always happy to help. And if they cannot provide an immediate answer, or cannot give you an immediate document that you're looking for, they will certainly direct you where you could find it, or will connect you with the person who's responsible for one thing or another. You just need to form your question properly. So when you call, you're saying, I'm a real estate investor. I'm planning to purchase a multi-unit residential property at your location. Would you be able to help me to find more information on, and then you say what you're looking for. It could be, I don't know, a city map. It could be your development plan. It could be your employers in the area, or could be something else. And we'll go through all these criteria in a minute. When you choose the area, when you start digging in, finding all this data, what do you need to pay attention to? Job sources, and job growth in the area. Why is that important? As we discussed, your income comes from rent. Rent is the portion of people, of salaries, of income of people who are going to be renting from you. These people have to have work. If they have steady employment, then it will result into steady rent coming into your business as well. This is why job sources are important. You need to understand if you have enough employers in the area to sustain your business. Because if you don't have enough enterprises or employers in the area, you will not have enough tenants who would be your good tenants paying rent each single month. Now, it's not only about numbers of those employers, it is also about the job growth in the area, because you may have employers in the area, but they are cutting jobs. It's not a good sign. And the opposite, if they are keeping hiring, that creates a good opportunity for your business as well. Now, unemployment rates, we've just talked about it, right? But it's not just current, it's the trend that is important. You may get statistics on the current unemployment rate when unemployment rate in the area, right? But what's important to look back and see what it was a few months ago or last year. It gives you a perspective. So if the trend is to have unemployment rates going down, it's a great sign for you. It's a great information for you to work with if you are about to purchase the property there. Then, talking about population, there are a few things to consider. First of all, it's an age. Let's pause here and talk about it for a second. There is no limitation of what age of people you want to rent to. There are no constraints or certain rules here, but there are things that are to be taken into consideration. For example, if you have people in the area who are between 40 and 60, will that be good or bad sign? It is always pluses and minuses, but 40 to 60 is usually a good group of people to rent to. Why is that? Because at this age, people, first of all, they don't move that often. So if you rent out, it's going to be a steady income from a tenant. Then these people normally have steady income. You'll have no problem collecting the rent. Then these people are normally kind of settled in life. They're not looking for something extremely shiny or extremely bright, especially if we're talking about middle class layer of our society. Okay, so it's a good group of people to rent to. On another side, if we talk about young people, let's take college graduates. They just off the college, they've just been employed. Is it good or bad group of people to rent to? Well, there are pluses and minuses. It's a good group from the perspective that they're easygoing. They are fine, again, no special criteria yet on how they select the property. And they have money because they just got their job, right? But on the other hand, they move quite often. They may not like something, they just take off and move to another location, or they change the job because they didn't like something here. They got the better terms with another employer that is in another area, right? And is it good or bad? Well, it's not good or bad. It's just something that needs to be taken into account when you look at a particular property that you are going to buy. Okay, and also with young people moving more often, what that means that you will have to budget for that, because each change of tenant involves money to be spent to clean up the apartment, to update it, and so on and so forth. So these things are simply to be taken into account. All right, another metric to look at when you analyze the area. Now, movement trends. The area is booming. People are coming into it. Well, it's a great sign. That means that when you purchase a property there in near future, you will have more people who would need a place to live in, and you will have no issues with renting your property out. And the opposite is true when you find out that the population is declining in the area. That means that your property or your property management actually may have difficulties to rent it out, so you will have more vacancies, bringing less income into your business. Presence of big shopping centers. It is truly valuable insight. Why is that? Because big shopping centers or big stores like Canadian Tire or Walmart or similar, these guys did an extensive research before they spent millions of dollars to build a facility at a certain location. If they did build it, they knew that this area is going to expand. It is, and for you, it's a good indicator that you are probably at a good location when you see something like that happening. Especially, it is important to understand when, for example, Walmart is planning to build something at the location. It's a great indicator for you to look carefully at this location as well. Okay, now household income. This is simply logical. Household income is where the money comes from to pay your rent. Okay, so looking at the level of average household income at the location, you need to pay attention to two aspects of that. First of all, looking at the building that you are purchasing, at the level of the rent that you are going to charge, you need to understand whether the average household income in the area is high enough to provide the payment of your rent. If it is, great. If it is below the rent that you're going to charge, well, you may have an issues. Certainly, it depends on, for example, what type of property you are purchasing, and we'll discuss that in a second. It depends on the absolute amount of rent. It depends on how many rooms in the apartment that is in your property. So all these factors are related to the household income. So when you look at household income, use it as a general metric, taking into account the type of property that you are purchasing. Now, entertainment venues, same as shopping centers. It's another small insight. It's not significant, but sometimes it plays a role. For example, if you have a big entertainment venue somewhere at a certain location that attracts people from outside, okay, yes, those people who come from outside the area to have fun are not going to be rent from you. But if the venue is big enough, for sure there will be lots of people who will be working at the location to serve that entertainment, okay? And these are going to be your tenants. So take it into account as well. If you see something like that, pay special attention. It's not a defining factor. It is not a decision-making factor, but it is one small piece that will add to your puzzle. Average family size, same as household income. It needs to be looked at in combination with what property you are going to buy. Certainly, if you're buying the property that has, for example, only one bedroom apartments, it immediately puts limitation to what tenants you are going to bring in. If the average family size in the area is 4, which will probably be dad, mom, and 2 kids, you may have less chances to rent out your 1-bedroom apartment or studios or bachelors in the area. That is simply logical. It doesn't mean that you should not buy a property like that. Okay, it is another indicator that you have to take into account. So if you look at the average family size and it says 5 and your building has no 2-bedroom apartments, well, the rent process will probably be more difficult than if you had all 2-bedroom and few 3-bedroom apartments in the property. Does it make sense? I hope it does. In any market, no matter where it is, no matter what you do, there are a few things that you have to take into account. One of them, you can change tenants and the building. You cannot change the location. What I mean by that? Certainly you cannot change a particular individual, right? But what you may be able to do when you purchase the building and it is, let's say it is dated a little bit, it is 80 years old and it was not upgraded for the last 5 years, but you got it for a good price and you still have funds to update it. It could be built into your profitability model. So when you do that, you will then be able to offer these rental properties to another class of tenants or different tenants type. So we've changed the building, we are changing the tenants. That's how it is possible. But under any circumstances, you cannot change the location. So if the area you're buying this building in is at wrong phase of the life cycle, of the real estate life cycle, there is no way changing tenants or building will help you. This is why market analysis is upfront of our program. This is why we're going through this with you with that attention. Now, you should have the ability to increase the rent. That's another thing. I'm not saying that you must not purchase the property that has no ability to increase the rate. Probably it would be too strict, but it is always an intention to increase the rent, especially when you purchase the property, you have that ability, okay? So that has two aspects as well. First of all, if you are purchasing the property and you look around and you see the rents in this property are lower than in other similar properties, you simply have that ability and you must increase it. That's simply logical to make your business more profitable. Another thing is, we discussed it, I'll repeat it again. If you purchase at the end of recession, before or during the recovery, you have natural ability to increase the rent because rents are simply going up elsewhere. Okay, this is important. Now, when I look at the area, no matter how small that is, there should be at least 4 major employers and they should have positive hiring trends happening. If you have 4 employers but they're cutting jobs, it is not a good indicator at all. If you have 3 but they're booming for the last couple of years and people are simply coming into the area because of that, well, that's a good sign to use. That's a good sign to take into account. Now, the occupancy. You need to look at the buildings that are similar to what you're planning to purchase. Similarity is it comes into at least 2 flavors. One, it is the building type. Just compare oranges with oranges. Okay, if your building is at certain state in terms of quality of accommodation, don't try to compare a vacancy in your building with the building that has luxury apartments in it. It wouldn't make sense. And second thing is talking about the building size. If you have 20 apartments in a building and the second or next building has, I don't know, 200 apartments in a building, the rents may be different and the occupancy numbers may be also different. So find buildings that are similar. Then they will never be the same, but similar, and look for the occupancy. 85% is the minimum number that you should have. If you see around the building are half empty or have 75% occupancy, I would avoid this place at this moment. Okay, if you see 85 plus, 90, 95 would be ideal, then it is the place to buy. Now, presence of property management services, it is really essential. You're not going to be becoming a landlord. Property management company will take care about your property and will provide you the service. So for that, you need to have them in the area. So make your research to make sure that you have at least few of them to choose from. It is also an essential vital indicator for you to make a decision. That's why it is in this list. And the last one, economy of your tenants. Again, you simply need to know who are you serving. And it has few elements to that as well. One of them, if it is a kind of lower level of our society, the question is, are you ready to handle these tenants? Will your property management company be ready to do that? Do they have an experience? Things like that, they're not a decision-making points, but they're all small pieces to your puzzle. So at the end, your decision will be well-grounded and your business will have less issues and problems, or at least if the business does have issues, you will be prepared to solve them. You will have a solution for the problem before the problem appears on the surface. Okay. Few other factors. One element I wanted to discuss or to show you is it is called zoning maps. These maps are built by local authorities. This map is simply geographical map representing the areas that are used for certain type of real estate properties or activities. What does this mean? So color-coded map, for example, yellow is residential here, okay, orange is multi-unit residential, and so on and so forth, including commercial. So what does this give you? There are a few approaches to look at a few kind of things you may extract while looking at a map like that. One of them, which is quite important, you need to look at what is going to be developed, because this map should have areas that are to be developed or planned to be developed or approved for future development, something like that. So look carefully. Why is that important? I'll explain it to you based on one example. Imagine that you purchased a multi-unit building in the area that has not that many offerings of similar kind to rent, I mean. So what happens? Your numbers are great, you have low vacancy, you have a decent amount of rent coming. And suddenly, few blocks from your location, at certain point, there is huge development. And there are 5 buildings of similar size to yours are built within 6 months. Okay? How will it affect your business? It certainly will, because now people have more opportunities, more offering to choose from. And while these new buildings will have higher rent, people may still choose them because they're new and shiny. What will you do in this situation? Well, you have few choices, obviously. One of them, for example, to put money into your building and bring it up to the level, but that requires quite significant amount of money, to be frank with you. Another option is to bring the rent down, but it will affect your bottom line. You could have avoided that if you look at the map like that and see that, well, actually next to the area where I was planning to purchase, it is a new development area to be developed next year. So you would be calling municipality saying, could you please tell me what is planned for that area? And if they tell you it's multi-unit residential, that would not be a good sign for you then to purchase what you were planning to. Does it make sense? Another thing here is it's about density of properties, or similar properties to what you're planning. So if you look in the area and see that your intention, the planned the building you're planning to purchase is in the mid of empty area, empty meaning no similar buildings are around, it may be a good indication. But again, you need to understand why is that. Maybe it is because there is no big employers around and the area is quite large. That will affect you negatively. Or maybe it is just historically happened and you are lucky to get this building and it is full of tenants all the time. That's the opposite side of the same coin, right? So again, this map, it is another source of information that I would recommend you to look at and explore before making your final decision. And as I said, it is free resource. Anyone could call and request that information that should be provided. And the last one, we're talking about rental price and rent control. This is something that you need to understand and to pay attention to. So what rent control is? Rent control is a mechanism that government is using to control the rent increase in some areas. Some areas do have rent control, some don't. Again, what rent control is? I'll try to explain you based on this simple graph. So we have price here and we have number of units there. So price on the market, number of units of certain type. We're talking about one certain type of real estate rental units. Okay, residential rental units. Now, this line represents the view of investors, or it is called supply line. The logic of this line is the higher the prices, the rent prices are in the area, the more likely investors will put money in and provide more rental units to be rented. It is just logic. The higher rent is, the more margin will the investors will have, and that's why they will be putting more money, resulting in more units. The opposite line or another line is the tenant's view. It may be called demand. The logic here is If the price is high, I don't want to rent that. If the price is low, again for the same type of unit, if the price is lower, I want to rent it. That results in more units to be in demand with lower prices. Okay, intersection of these lines is where the market price, market value price would probably be. Okay, so what rent control is? Rent control normally puts a constraint on annual increase of rent in the area. It is set on annual basis. That means that if you want to increase the rent in your property, you can do it only once per year, and the maximum percentage you could increase it for is the one that is defined. As an example, 2%. Is it good or bad? Normally, it is when you have this rent control in the area, it is less attractive market for the capital because it is simply less profitable. You could have had this price coming in as rent instead of that you are having lower value. Certainly, it is not as attractive for investors, which results into lower supply. Okay, and this is where the intersection between regulated rent and supply line is. Now, on the other hand, since it is less than market value, the rent is less than market value, you have more demand, more tenants want to rent in this area because they're paying less than the market price, which is again logical. What does this create? This creates this interval or gap or undersupply. So while we are saying that it is less profitable, on the other hand, more people want to rent there because it is less expensive, which may give you more opportunity to easily rent out your apartments. I hope you understand the logic here. And again, this is not something to be afraid of or to avoid. You just need to take it into your equation. So if you are looking at the property and rents are at good level and it is at right time of the market to purchase it, you may not need to increase rent that significantly. And if this is the case, rent control is not an obstacle. On the other hand, if you are buying where rents are really low and you do need to increase them in order to be profitable and rent control is there, I would avoid making that decision for the reason that I've just given you. Okay, we discussed lots of criteria that you will be using evaluating your markets. Now, I put together this simple table. It is an Excel spreadsheet. You will have to download it from the resources on our website. What you will have to do while exploring different areas, going through research and evaluating all this information and data that you will see, just put comments into each box when you see something related to a particular criteria in the area that you are looking at the moment. And then you'll have this field with details that will provide you with the data that you will be using to map the area of interest, putting it on a diagram, on a plot that I showed you previously. As simple as that. Again, nothing complicated. The information is freely available. You now have the sources for that. This is the form that you will be using to put this data in while you are doing your research, and then resulting graph would be your decision-making tool. So, as you can see, as I told you, it's not that difficult or complicated. I want to come back to this location question. I've seen and heard it many times coming from people who are new to real estate investing. They're saying, well, I looked around my place and there was nothing that would fit buying criteria in there. With all due respect, it doesn't matter. Simply get over it, okay? Keep looking at other places. 3 to 5 hours driving off your location is totally fine. I can tell you even more. You may be looking at a different side of the continent if it is the good region to invest in. Just plan flying there, the cost of your trip into your business model, and it's going to be just fine. You'll have to be there only a couple times per year. Now, you will need to be at the property sometimes, but it is only, as I said, a couple of times, so not big deal. The property management company will be your eyes and ears at the location. You need to trust them. You need to learn to trust them. It is their responsibility. We'll discuss how to choose your property management company later, but I'm just saying to you that never try to be close to buy a property close to where you live. There are a few reasons for that beside what I've just mentioned. One of them, it is just psychological. People tend to manage the property themselves if they are close. So imagine that you purchase a property that is a couple of blocks from your house. Wouldn't it be tempting for you to go there every single day or at least a few times per week and see what's happening? And that is not a good thing to have, because first you will interfere with the process that your property management company wants to establish. You will irritate property management, which will hurt your relation with them, and you don't want to have that. That will hurt the business at the end. Okay. Now, another reason is if you have that rental property close to your place of residence, tenants are people, right? So all people are different, and at certain moment, sometimes, and it is happening, not that quite often, but it does happen, people start complaining about something. So if you have your property close to where you live, you really don't want tenants to come to your door starting complaining about something. That's the responsibility of your property management company to handle, and you don't want to be involved, and you certainly don't want to face tenant with their complaints about something. This is another reason. And people are smart. Internet is a good source of information. They will find you, trust me. If you're in another city, it would be quite problematic for them to come and they wouldn't bother. But if it is next door, well, why not? Try to avoid that. When you embrace this concept, when you understand this concept that you are not the landlord, you don't have to be at the property. You need to trust people with what they do. You will then run business much more successfully. Trust me with that. I've been through that phase. I've seen people going through that phase. I've seen lots of negative emotions because of that. This is why I'm saying look at other location. Of course, if you are at the middle of the market, that is at right time, at right place, and it is the property to purchase, yes, you will be purchasing that. But I'm saying that if it is not the case, and actually I would prefer starting elsewhere and then coming to your location if you cannot find it elsewhere. So that's your goal. You are not the landlord. That's the bottom line. All right. Okay, and now we came to this to-do or homework. You now have all the information and all the data. I led you through the process, explaining all the details on how to approach market valuation. Now you have to do it. So what I want you to do now is first go online and find related information using all those resources that you will find in the file that you will download. Spend on that at least a couple of hours, at least. It certainly depends on the person. So 2 hours is an indication for you. If you need more, feel free. Now, I don't want you to spend a lot of time on this, trying to Google and search for all possible situations, criteria, and so on and so forth. Information that will be available for you, if you use those links that I provided, will be more than enough for the purpose of this exercise. Okay? So don't kill yourself. You don't need that. When you go through these links, through the content, make yourself familiar with the terminology, because you need you need to learn to speak the language of the industry. It is simply just for your benefit. Now, what you need to do next, choose any 2 cities across the country. Doesn't matter where they are, just choose random cities, and then using the criteria that we've been discussing and the sources that you will be going through, try to understand where those 2 cities are in real estate life cycle. Okay? When you do that, put all these comments into the Excel spreadsheet that I gave you, so you keep this information in one place. Do macro analysis using all these resources. And if you are able to find information on a micro level, like a city level, then try to compare these 2. They should be in sync, but I want you just to get an experience to see the difference between macro analysis and micro analysis. So small area versus countrywide scale. Number 2, for 2 selected cities, you will need to create this map where you analyze all this data, you put it all into Excel spreadsheet, and then put these squares or rectangulars on the plot with real estate life cycle. So I want you to have similar picture with places that you've been looking through, using the same kind of approach, right? And this exercise will allow you to do exactly that. When you have that map, I want you to answer 2 questions. Question number 1, why would you buy or not buy real estate in this particular area and this particular moment? That's the question number 1. And the question number 2, where do you think these cities will be in 3, 5, or 7 years time frame? The second question, it is quite important because in order to answer this question, you will first need to get all the information that we've been talking about. Then you will have to map this information into Excel spreadsheet. You will need to understand how long is the real estate life cycle in this particular place. So there's only one question. If you want to properly answer that question, you will kind of have to go through all these exercises, through all these materials, and to do what I'm asking you to do here. Okay. And the last challenge or last thing here in your to-do list would be pick up any city that everyone is buying properties in right now. Simple question, but to answer that question, you'll have to perform all the above, because you will have to understand that this particular city where everyone is buying is indeed in that expansion, probably the end of expansion. And then you'll have to collect all these indicators and summarize the criteria that would confirm that conclusion. And only then it would become obvious that yes, it is an expansion probably phase. And this is why people should not be buying that much at that time if they want to be profitable. But they still are, probably because they have not attended a course like that, a program like that. All right. So this is your homework. Please spend as much time as you need. Try to be focused and diligent while doing that. As I said, this step is really important. If you buy at random location, you have a chance to succeed. If you first analyze the area of your interest and do what I'm asking you to do, you will succeed without any if or question mark at the end. Now, with that, let's close part 1 of step 1. And when you have results of all the homework done, I will be looking to see you at the next video.